Hi, I'm Richard Vague with Tycos. In recent weeks, there's been a surge of warnings regarding investments in private credit. The FTSE Russell cautioned about similarities between private credit and junk bonds from the 1990s, while Pensions and Investments magazine highlighted red flags in the private credit market based on Moody's ratings. Euromoney and BNN Bloomberg also reported on concerns raised by the IMF and an ugly moment in Wall Street's hottest trade, private credit. These warnings have come in part because several large investment banks have just announced an increased commitment to private credit investments, making analysts concerned there may be too much money coming into this sector. And also, concern has been expressed because of higher interest rates that have stressed many of these loans. Some of these warnings have reminded observers of the dark days when losses on 1980s and early 1990s junk bonds of Milken and others reached an ugly 10%. So what is private credit? It's a type of debt instrument that non-bank entities use to provide loans to private businesses. A company in need of debt financing can get a loan from a bank, or issue bonds to the public markets, or can turn to private credit, working with a single lender to borrow. Historically, it has often been used for leveraged buyouts or debt refinancings, and borrowers have typically been small and mid-sized businesses that lack credit ratings and do not issue securities traded on public markets, even though more recently it is extended to larger and more creditworthy borrowers. So let's dig into this a bit, first by asking whether private sector debt as a whole, and by that I mean the entire $42.5 trillion of business and household debt, has reached problematic levels. What you may find surprising is that aggregate private sector debt as a percent of GDP now is roughly flat with the level 20 years ago in 2004, and is actually down 10% since the global financial crisis. Let me repeat that. In ratio to GDP, the private sector is now 10% less leveraged than it was just coming out of the great financial crisis. Public or government debt, of course, has skyrocketed, in part to fund our regular government deficits, and in part to prop up and rescue the economy at its darkest moments, the global financial crisis of '08 and the pandemic of 2020. As a percent of GDP, public debt is now well more than double its level in 2004, and a whopping 46% higher than it was in 2009. And at that point in time, it already included Obama's $787 billion stimulus package. But to repeat, on the aggregate private debt side, the ratio to GDP has been benign. So now let's dig inside of that overall number and look at that small subset of overall private sector debt that is considered private credit. We don't have an exact number, but most estimates put the current total at $1.5 to $2 trillion. And we do have totals for non-financial private placement debt, which is debt associated with privately raised capital, and that's an overlapping category and a reasonable proxy for private credit. This private placement debt has grown pretty sharply. It grew at a brisk 42% at the beginning of 2019 to the end of 2020, then was absolutely flat in 2022, and now is percolating again with an annual 8% growth rate and stands at $1.57 trillion as of May 2024. But for the purpose of assessing the threat of credit problems in the private credit sector, you'll notice that it is only a tiny slice of the overall private sector debt total. It's only 7% of all business debt and only 4% of total private sector debt. Now, our view is that losses in this sector will likely rise since lenders do appear to be taking on some additional risk. Could be a problem, but within tolerable levels. But let's assume the worst. Let's say that private credit market turns ugly and losses reach the same miserable 10% that Milken's junk bonds did in the 1980s. If so, that would be losses of $160 billion in a financial services industry that has over $2 trillion in capital. So it's a total we consider manageable. Even in Milken's day, junk bonds only reached 3% of total private sector debt. And though they were a symbol of the 1980s excess, it was profligate commercial real estate loans that brought the economy-threatening credit problems of that particular era. I would say as an aside that the banking industry itself, with the continued presence of higher rates, is experiencing some general overall threat, and we'll examine and try to dimension that in a future video. Thanks for joining, and if you've enjoyed this video, please comment below to let us know what topics you would be interested in for future videos. That's it for this week. Thanks.